In the previous section, we explored joint tenancy and its defining feature, the right of survivorship. This section expands on that concept by introducing other forms of shared ownership that also involve special relationships among owners, particularly those between spouses or business partners. Understanding these ownership forms is essential because each carries its own implications for survivorship, control, transferability, and liability. Tenancy by the entireties. Tenancy by the entireties is a special form of ownership that exists only between spouses. Traditionally reserved for husband and wife, it is now available in many states to same-sex spouses as well. This ownership form is based on the legal idea that the couple is one single entity. Each spouse owns the whole property, not a divided share, and together they form an indivisible ownership unit. The most important feature of tenancy by the entireties is the right of survivorship. When one spouse dies, the surviving spouse automatically becomes the sole owner of the property, bypassing probate entirely. For example, if John and Maria own their home as tenants by the entireties and John passes away, Maria immediately owns the property in full. Each spouse has an equal, undivided interest in the property. Neither can sell, mortgage, or otherwise transfer their share without the other's consent. This unity of ownership ensures that the property remains protected within the marital relationship. For instance, if Maria wanted to refinance the home, John's signature would be required on all related documents to ensure that both parties agree to any encumbrance. One significant benefit of this form of ownership is protection from individual debts. Creditors of one spouse cannot force the sale or foreclosure of the property to collect on that individual's debt, provided the debt was not incurred jointly. Only debts or judgments held by both spouses together can affect the property. This feature offers important financial protection for married couples. Tenancy by the entireties can be terminated in several ways: by divorce, death, mutual agreement, or a judgment for joint debt. When a couple divorces, their ownership automatically converts to a tenancy in common, where each person holds a separate interest. Community property. While tenancy by the entireties emphasizes unity in ownership, community property focuses on fairness and equal partnership in marriage. Arizona is one of several community property states, which means that property and income acquired by either spouse during marriage belong equally to both. Community property laws classify property into two categories: separate property and community property. Separate property includes assets owned by either spouse before marriage, as well as property acquired by gift, inheritance, or with separate funds during the marriage. Community property includes all income and property acquired by either spouse during marriage, except those classified as separate. For example, if John and Mary marry and later buy a house together, that house is community property. If Mary inherits $10,000 from her father, the inheritance remains her separate property. However, if she deposits that money into a joint bank account and it is later used for household expenses, the funds may become commingled, turning them into community property. Under Arizona law, both spouses must sign to sell, mortgage, or transfer any community property. Neither spouse can act alone because the property is equally owned. Upon the death of one spouse, half of the community property automatically belongs to the surviving spouse, and the other half passes to the deceased spouse's heirs through will or intestacy laws. For instance, if John and Mary own a house as community property and John dies, Mary retains her half, while John's half passes according to his will. However, if they own the property as community property with right of survivorship, Mary automatically inherits the entire property without probate. Community property principles are designed to protect the equal interests of both spouses, ensuring that contributions made by either, financial or otherwise, are recognized. Tenancy in partnership. Not all ownership is personal or marital. When two or more individuals join together for business purposes, they may own property as tenants in partnership. This form of ownership is governed by the Uniform Partnership Act, which provides a legal framework for managing partnership assets. In tenancy in partnership, all partners hold equal rights to use the property, but only for business-related purposes. For example, if Alex and Jordan form a real estate investment partnership to purchase commercial property, that property is held in the name of the partnership, not by either partner individually. Individual partners cannot transfer their ownership rights to outsiders because those rights belong to the partnership as a whole. If the partnership dissolves, the property must be sold and the proceeds distributed among the partners according to the terms of their agreement. This type of ownership ensures that business property is protected for use in the partnership's operations and not subject to individual claims by one partner's personal creditors. Timeshares. Another unique form of shared ownership found in resort and vacation properties is the timeshare. Timeshare ownership allows multiple individuals to share rights to use a property at different times throughout the year. Owners or tenants agree to use the property on a scheduled, non-overlapping basis, often for a specific week or month each year. Timeshares can be structured as either timeshare leases or timeshare freeholds. In a timeshare lease, a tenant leases the property for a designated time each year under the terms of a lease agreement, which may last for several years. For example, a tenant might rent a beach condo for the first week of July each year for 10 years. In a timeshare freehold, also known as interval ownership, each participant owns a fractional, undivided interest in the property as a tenant in common. The ownership is permanent, and each owner is responsible for their share of expenses. For instance, if 12 families purchase a mountain cabin together, each might pay 1/12 of the purchase price and share 1/12 of the annual costs. Each family then enjoys exclusive use of the property for 1 month per year. Timeshares are heavily regulated to protect consumers. Many states require disclosure documents, a cooling-off period that allows buyers to cancel contracts shortly after signing, and registration of advertising to ensure accuracy. These rules are designed to prevent fraud and misrepresentation in vacation property sales. Review summary. Tenancy by the entireties, community property, tenancy in partnership, and timeshares each represent different ways of sharing ownership rights. Tenancy by the entireties is limited to married couples and offers survivorship with protection from individual debts. Community property divides marital assets into separate and shared categories, ensuring equality in marriage. Tenancy in partnership allows business partners to hold property collectively for partnership use. Timeshares offer a modern and flexible approach to property ownership, particularly for vacation use, allowing multiple parties to share costs and access on a scheduled basis. Discussion. How does tenancy by the entireties protect married couples from creditors? Answer. Creditors of one spouse cannot force a sale or foreclosure of property held by the entirety unless both spouses incurred the debt jointly. What distinguishes community property from separate property in Arizona? Answer. Community property is acquired during marriage by either spouse, while separate property is owned before marriage or acquired by gift or inheritance. Why can a partner not sell their interest in partnership property? Answer. Because the property is owned by the partnership entity, not by individual partners, and must be used for partnership business. What is a key benefit of owning a timeshare? Answer. It allows multiple individuals to share ownership or use of a vacation property without the costs of full ownership. Closing remarks. Each ownership structure serves a distinct purpose, from protecting families and marriages to supporting business partnerships and lifestyle choices. Real estate professionals must understand these forms of ownership to properly advise clients, ensure clear title transfers, and recognize how laws differ between states. Always encourage clients to consult legal and tax professionals before deciding how to vest title, as the form of ownership chosen can significantly affect future financial and estate planning decisions.